Good morning, everyone. Good afternoon and good evening as well, depending on where you are on our lovely planet this morning. This is Joseph Trevisani for Worldwide Markets. I speak to you from a very snowy and very, very cold New York City. We had about a foot of snow last night, and it's about 10 degrees outside Fahrenheit. That is very cold for this part of the world. Our topic today, the Euro bubble, or the Yellen bubble as I call it, what keeps the Euro aloft, might also be called one of my favorite topics in markets in general, currency markets in particular, the irrationality of markets. This reminds me somewhat of the long period leading up to the financial crash in 2008, when everybody in creation was supposedly funding in yen, the carry trade. When we look, and here's the chart right here of the euro. When we look at the euro, our question has to be, what is the euro doing at this level? The fact that it's here is not terribly remarkable, but why is it still here? Let me put it another way. It is not enough. Currency markets and markets in general, but specifically currency markets, because that's what I'm talking about, operate on what I call scenarios, a particular view of the world. When I first started trading 25 years ago, matter of fact, I was supposed to have drinks with one of my old trader colleagues from 20 years ago today, but he has to do something, so we canceled. But when I first went to the desk, I didn't have a clue as to what was going on in currency markets. I showed up in my tweed jacket, an English major with a graduate degree in finance. I had no idea what was going on, none whatsoever. I used to sit there and do the New York Times crossword puzzle, and they looked at me like I was from another world, which primarily I was. But one of the things that people said to me, traders are not particularly talkative, nor are they particularly insightful, at least verbally, as far as their profession. Trading at that time in that way was very instinctual, far more than an analysis the way we perform now. But they said you have to have a view. I don't know what they meant. But this is exactly what they meant. It's exactly what's going on now. The view is the bias. It's the general tilt towards the market, towards a currency in general, towards what you think is going to happen. So when you look, or when you're sitting at a trading desk in those days and trying to decide whether to be long or short or what to do in some instantaneous section, 2 seconds, 3 seconds when someone's giving you a position, your view makes the balance on your decision. Most of the time in that market, you would have covered the position. Your job, as I worked for Credit Suisse, was a liquidity maker. Your job is to provide liquidity to the customers and to the market and get out of the positions and make money. Most of the time, you simply covered the position. If you could, flat, better yet, at a point or two profit, a point loss if you have to, but you get out of the position. You don't sit there and wait for it to turn into a profit. Recipe for disaster. Recipe for losses. But one of the things which might help you make the decision is your view. So if someone just gave you, say we were trading euro, which didn't exist in those days. Of course, we were trading the Deutschmark. But say someone gave you 20 million euro, $20 million mark, as it was called in those days, the dollar against the mark. You were long the dollar and short the marks. Somebody else sold the dollar, you bought it. That's what the currency markets did. That's what traders did. So should you sell this or not? You're not getting a lot of information out of the market. In other words, the market's been trading fairly level for the past half hour. So you don't have a lot of indication from the market itself about what to do. But if your view in general is that the dollar is probably going to strengthen based on something, it could be because the Fed is in a rate hike cycle. It could be because we have bounced off the bottom 3 times in the dollar against the mark, and it's more likely to go up having tested the bottom. You're more likely to hold that position for a minute or 2 minutes or 3 minutes, probably not much longer, to see if the dollar goes up against the market, at which point you'll sell it at a profit. So that view informs your decision. In a similar fashion, the view now on the euro has been stronger, primarily due, I have felt, to quantitative easing. Whether or not it actually has a lot of effect is irrelevant. When there is a decision to be made, the bias has been, at least since July, as you can see on this chart, for the euro to get stronger. This scenario does not have to be based in economic reality. And sometimes when you are seeing this picture as traders, even if it's completely at odds, as I'm going to demonstrate, I hope that it is, with economic and rate reality, it is not enough that everyone knows this. And everyone can sit there and ask the same question. What is the euro doing at these levels? It takes more than economic analysis. It generally takes a triggering event to make the markets realize. And the triggering event can be of many different types. It can even be technical. The market could go through a certain level, and that would convince everyone that the reality has changed. But until that trigger strikes them, it could be news. Until that trigger strikes the market, the irrational aspect of the market, at least compared to economic analysis, will remain in place. So, let's take a look at some of the traditional comparisons. Now, the comparison we've been making for 5 years, basically, or the situation in the currency markets for the past 5 years, has been, and as everyone knows from who attends my webinars, anyone who would like to pose a question, a comment, criticism, just type it into the chat box, and I'll be glad to stop and consider the comment, talk about it. I prefer this to be as a colloquium rather than as a lecture. So please participate to any degree you find interesting, or comment on anything that you find interesting. For the past 5 years, we have been sort of in a state of suspended animation when it comes to the traditional types of analysis that markets do and have done, currency markets, comparing currencies. Generally, that's an economic analysis which shades over or informs central bank rate policy. That's the traditional standard way of looking at it. The view that I was speaking about earlier could easily be one informed by differing rate policies of central banks. If the ECB or the Bundesbank is on hold in general, but the Fed is raising rates or has raised rates in its last meeting or in its last move, then unless something has changed, you have a bias towards the dollar. That's what I was speaking about earlier, is if you had a scenario. But for the past 5 years, because of the extraordinary interventions in the market, primarily by the Federal Reserve, but by other banks as well, the rate policy has not been informed, at least not to the same degree, by economic reality. The European economies have been in terrible shape, especially since the Greeks discovered that they owed a lot more money than they thought. But let's take a look at the euro rate. Okay, this is actually a comparison. Bloomberg charting is just awesome. These charts are all from Bloomberg. Okay, this is a comparison, and I'm going to take this down quickly because I just want to show it to you briefly, of the difference in the approach to the financial crisis of the ECB and the euro. If you look at the top chart here, the white line is the Fed target rate, and the yellow line is the ECB main finance. And you can see the discrepancy. The ECB has been both later and tardy, later and less demonstrative in lowering its rates. It has now reached, finally, under Draghi, after 5 years, it has reached the same rate that the Federal Reserve is at. Now, does that mean that the EMU economy has performed much better? Hardly. This is GDP in the EMU. This is quarter to quarter. And this is in the U.S. The U.S. has easily outperformed the euro. But the reality of the past 5 years has been one of Fed domination of the policy. There have been two things going on. If the markets were not terrified, in which case they fled to the dollar, as we saw in 2008 and have seen at other occasions since then, such as when the European debt crisis blew up in the fall of 2010, or first got noticed the fall of 2010. So unless there is something driving people to the dollar, QE in all of its incarnations has been driving people away from the dollar. This has been the primary pattern. And as you can see, it doesn't relate to the economic comparison between the EMU and the U.S. Because throughout that period, the U.S. has done much better. Its growth is stronger, its unemployment is considerably lower, and it has not gone back into a recession. The EU went back into recession for 6 quarters after 2008, and only came out in the second quarter of this year. So the comparison is all towards the dollar. Yet the euro has been, by and large, stronger than the dollar throughout that period. The difference has been the quantitative easing policies of the Fed, which the markets hate. Even though there isn't a lot of proof that it is, one, having much effect on the U.S. economy, or two, having a lot of effect in the currency markets. How exactly would it have effect in the currency markets? The currency markets are already 90% or more speculative. The ECB, the Fed, is not adding a lot of speculative juice to the markets the way we suspect it has, although you can make arguments about that for some of the emerging market currencies, and certainly for the Rial and for the Indian rupee, and probably the Malaysian rupiah, that I've spoken about at prior seminars. Because there, the markets did seem to turn to those currencies and their stock markets for added return. Let me just take a look at this question here. I agree with that. It has always been a political question. In other words, the European bureaucrats, the European officials, the European governments are not going to permit the euro to fall. Even the Greeks, under current rule, the only way that someone will leave the euro is if there's a political upheaval and a government that deliberately targets the euro is elected. And it seems to me that no country has the courage or the nerve, courage implies some sort of judgment on it, to do that. In the long run, Greece and Italy and all of the other countries, if they stay within the euro, two things will happen. They will be forced to their finances to the liking of the Germans, to the way the Germans think things should be run. And there's a lot to be said for what the Germans are doing. I know people don't like it. Germany gets a lot of criticism. But in fact, Germany's point is you can't continue to run deficits like this. If you're not producing and you're not productive enough, then you can't spend the money. And in the long run, it's hard to argue with that. But if Greece could, as an example, I want to pick on Greece as an example. If Greece could drop the euro and get rid of all its debts, then it was no doubt that the euro is a drag on the Greek economy. But Greece can't do that. There's no way for it without further impoverishing itself to get rid of the euro. So they are very much stuck, and I don't think that they are going to, unless things get considerably worse, to drop the euro. Although there is that party in Greece, Caesarea, I think it's pronounced, has been anti-euro. But by and large, the euro is not going to go anywhere, and it seems very difficult to predict how there would be currently. I know it was very, very much in vogue 2 or 3 years ago to talk about the collapse of the euro and how it was inevitable. It has turned out quite not to be inevitable. Okay, so the comparisons that go into traditional economic analysis and a traditional currency analysis appear to me to be returning. The chief reason for this, that I'm saying this, is because the Fed has decided to stop, and we'll see if it continues, its quantitative easing policies, or at least to curtail them. So let's go through some of the comparisons right now. Actually, I have a column on this which will be coming out tomorrow. You can, same title actually, or maybe I'll change a little bit, which you can find on our blog page. It'll hopefully be posted on Real Clear Markets and a few other places. But I'll just read you the opening sentence I have for this. By almost every comparison, the dollar should be rolling up its European competitor. American economic growth is far stronger and accelerating. The Federal Reserve has begun a tightening cycle, while the European Central Bank is looking for novel ways to loosen its monetary policy. And the spread between the 2-year Treasuries and their Bund equivalents, which is probably the most important for currencies rather than the 10-year, although the 10-year is more important for the economy in general, has more than doubled since mid-December. Excuse me. But the euro has hardly budged. It's been trading in the same range for 4 months since it broke higher on September 18th. So what is going on with this? Why are we looking at a euro and currency markets which refuse to take clues from the markets as to what's actually going on? Let's just look at the comparisons right now. The annualized growth in the U.S. in the third quarter was 4.1% for the third quarter. It's probably going to be around 2.5 or 3% in the third quarter. The World Bank projects 1.8% GDP for the whole of the year and 2.8% for 2014. The Fed projects, as usual, a little more optimistically, 2.9% and 3.1% for 2.9% for 2013 and 3.1% for 2014. I find that Fed projection for 2013 a little preposterous. In the Eurozone, since they don't publish annualized rates the way the U.S. do, let's take a look at the World Bank, the same projections. For 2013, the World Bank projects a 4% contraction for the EMU. That compares to a 1.8% growth in the U.S. And for 2014, the World Bank projects a 1.1% growth, and the World Bank projects 2.8% for the U.S. So the U.S. economic growth is more than double. So what is the euro doing up here? Let's look at another comparison. This is my favorites. It's often been said, and I've said it myself many times, I think the euro will go down from here. I'm attempting to make that argument. So let's take a look at the 2-year, which probably has, well, first of all, let's take a look at the ECB and the Fed funds rate. We took a look at this already. The differential in the target rate had been this negative on the bottom chart from 2008 until just now, means that the euro had that the ECB had higher rates. So there was an advantage to the euro. That advantage on the target rate is now eliminated. Okay, but those are target rates. Let's take a look at the actual 2-year. Okay, this I have found fascinating. Okay, look. On the upper chart, the yellow line is the German 2-year Bund, the generic. What that does is that puts together all the rates of all the various bonds that are out there, because bonds have specific terms. They may be 2 years, but they start at different times. And the top rate is the U.S. generic 2-year. The bottom chart is the differential, to the advantage, of course, of the U.S. security. And look what has been going on since December. The differential, the advantage of the U.S. 2-year has gone from here, which is probably about 0.06 or maybe 0.07, to 0.22. That's a tripling of the differential. What's going on in Europe? Well, this is the German Bund. There are no European securities, as we know. The equivalent that most people look at is the German Bund. It's kind of Europe, powerhouse, only during the Second World War. No, excuse me, did I say that? If you look at 50 years, it does certainly look like the Germans actually won the Second World War. Never mind, I should get away from that. That's not going to get us anywhere. The European, of course, ECB has been lowering rates. Let's take a quick look at the Fed. This is the German Bund. Rates going down. Here is the reason. One of the reasons, anyway. Response to this, the ECB has been lowering rates. So we have an We have an increasing differential to the benefit of the U.S. currencies, we would think, since the middle of December, since actually early December. Yet, what's been going on with the euro since the middle of December? Well, it's come off a little bit, right? It was up here. This was the 27th. You can discount that one. That's a lot of thin liquidity in December. You always get bizarre moves. I mean, one of the most tradable moves, if you go back 10, 15 years, for a long time, it's been just reverse whatever happens in December, especially in the major currencies. Take a look at your charts. You'll see it over and over and over again. So, if you were here, first day of the trading day of the year, the second trading day, and you're going short the euro, you made almost 3 figures on it, or could have made almost 3 figures on it. So, this is a pattern which I advise everyone to take a look at. Of course, nobody's really interested in trading in December, at least in the West. It's holidays, and that's one of the reasons. So, anyway, take a look at that. So, even though you have this tripling of the differential between the Bund, the 2-year Bund, and the 2-year Treasury, since the middle of December, you've had a minor fall in the euro. Okay? We're right back where we were in the beginning of December, basically, a little bit below that, but certainly within the range, and we've not broken 135, the figure. I actually posted something about that yesterday. What is it about 135, the figure? Well, the only conclusion I could come to after looking through all the evidence is there isn't anything about 135, the figure. It's not on any Fibonacci levels. It's not on any trend lines. It's not on any moving averages. There's particularly nothing about it. Sometimes stuff just happens. And even as far as a level that has turned out to be a level that the currencies have bounced off of, it's not particularly important. There were these 3 days back here. Anyway, you can go read my post. It's on yesterday's blog, actually. I wrote it from home because we had this enormous snowstorm. I started to go out to work at 9 o'clock in the morning. I live in New York City, and I drive out to New Jersey, which is where our office is. And there were like 2 inches of snow on the ground at 9 o'clock in the morning. So I brought my wife to the Whole Foods and turned around, went home, and worked from home yesterday. Took the kids out last night. I'm sure this is fascinating to everybody. So anyway, they had a lot of fun in the snow. They look like little penguins all wrapped up. So, there isn't anything particularly about 135, the figure. It simply seems to have been there at a time when the euro and currency traders have run out of reasons, which I'm going to talk about, to sell the euro. Although I think those reasons are coming back. So, no, this chart is up to date. This euro chart right here goes right up to yesterday. On one or two of the other charts, which I'll show you, they are actually I haven't showed you those charts yet. So no, this chart is right up to date. This is yesterday. I'm not sure what you mean about the past level, but let me continue, and I'll just watch what you have to say, and we'll comment on it. Okay, so we have economic growth in the U.S. Yes, you are right. I'm sorry. The EMU GDP and the U.S. GDP numbers only cover the third quarter because the fourth quarter numbers are not out yet. Okay? Okay, so let's go back to, now let's take a look at the 10-year, the Bund in the 10-year. This is actually this is interesting in its own way, although it's a little different. This has less impact on the currency markets because it's a 10-year bond, right? Look at this. This tells you what the markets are thinking is going to happen in the next several years. They think U.S. rates are going higher, but they don't think that there's going to be that much differential change in the 10-year rates. Again, we have the U.S. here at the top line, and we have the German 10-year Bund. Again, we see a downward cast in the Bund since the ECB is lowering rates, okay? But look at the differential. The differential is relatively stable. So this differential is not driving the currency markets. Now, in general, as I said, this particular differential does not drive the currency markets. The two-year difference tends to drive the currency markets simply because currency markets do not have that long a view on the markets. Okay, let's keep going. So we have ECB rates. We have far stronger U.S. economic growth. We have far stronger economic growth. We have let's talk about this. The Fed is in a tightening cycle. I know that the Fed says they're not. But since quantitative easing is the Fed monetary policy. And when it changes, that means the Fed is changing its monetary policy. You look at the 10-year, since the summer, 2.5 to 3. And if you look, of course, back further into May, the early part of the summer, the 10-year has gone from 1.6 to 3. That is a tightening cycle. Let's take a look at the 2-year. The 2-year moved less, but it has still moved. It has moved from 0.2 up to 0.5, and now it's about 0.4. That is a tightening cycle. The Fed can say whatever they want about what they're doing. And what the Fed, by talking that they're not in a tightening cycle, that they're watching their rates, what they're trying to do is prevent this. I actually don't have the tighter rein, but let's take a look at it now. What they're trying to do is prevent this from 1.6 to 3 in just a few months. That's what they're trying to prevent. They are trying to keep the rates lower by jawboning. Yes, you're correct. If you took an actual 10-year index for the EU overall, of course it would be quite different because you'd have to factor in all of the southern tier economies which have much higher rates. That's precisely why I didn't do it. Because there is no overall EU bond, and the largest driver, because think about it, I mean, you could do that, and then you would say that, yes, the EU advantage, if you factor in all of the bonds, you could say would be driving the euro higher. The problem with that argument is twofold. The market rates, the size of the bond markets in some smaller countries that have higher rates are very, very small compared to the U.S. Treasury market. So even if somebody will extremely long the Spanish debt or Greek debt, the overall is still much smaller. It doesn't have that much comparison. In addition, many banks, or as many as they could, dump those particular treasuries. And in addition, on top of that, the rates in all of those countries have been coming down. Portugal, Spain, Italy, Greece, the big ones, have been coming down. So in fact, the advantage in the same time frame that we're looking at here, the prior advantage, if you take a composite EU, which would be an artificial one, because there is no EU debt, that has also been coming down. So the advantage that would have had, which you could say was driving a stronger EU, a stronger euro, has been declining. So the widening differential for the U.S. and between the Bund and the declining for this artificial composite would point in the same direction, which would be a strengthening dollar, not a strengthening euro. So that's why. But also, there's really no way to get those figures aside from having your own research department, because they don't really exist. I looked on the Bloomberg for a composite EU, and it would have to be issue weighted as far as size goes for the outstanding market. But I couldn't find one. It may exist, but I couldn't find it. Okay, so the Fed is in a tightening cycle. I know the Fed has been saying we're not going to raise. What they do is they extend guidance. Extending guidance is nonsense. Because what does it really mean? It means that the Fed promises not to raise rates until they need to raise rates. So the Fed can say in their guidance, 2096, we're going to keep the Fed funds target at 0.25% until our grandchildren are having grandchildren. But what happens if in 2015 the inflation starts to heat up? What's the Fed going to do? They're going to raise rates. So the idea that guidance has any reality for Fed policy is nonsense. What it is a rhetorical tool to keep the game in play, to keep the credit markets primarily from getting too far ahead of themselves by raising rates. Because whatever you want to say about the U.S. economy, it may be doing better than others, but it's not terribly strong. And even though you're getting some economic growth, it's debatable how much foundation there is there and all sorts of other things. If it's driven by business investment, and it seems to be lately, business investment is something which can change very quickly because you only invest in plant and equipment and hopefully employees if you're anticipating sales. You don't get sales, you pull back the next thing. So it's not as if it's driven by a rising tide of consumption or the broader economy. So far it's not. So the Fed is attempting by its rhetoric to prevent what it cannot prevent with its own rate policy. In fact, what it is diametrically opposed to by its own rate policy. The Fed is attempting, and so far they've been pretty successful, to have it both ways. To end quantitative easing because it's not really doing any good, but to prevent rates from rising too much. So far they've been successful. It has been my opinion that their backtracking in July that sent the euro soaring and sent the dollar going down was specifically to send a warning to the markets. Don't get ahead of yourself. The rationale for the Fed cutting its quantitative easing amount was exactly the same in September as it was in December. It was absolutely no different. It didn't do it in September when everyone expected it. It did it in December when very few people expected it. And the reasons have to do, I think, with the Fed in the first day in September to practically to put a shock to the currency market, not the currency markets, the credit markets, which were getting ahead of themselves, and which the Fed was concerned could do real damage to the economy. Okay? But the logic was exact, and the credit market said, whoa! And this is what you're seeing right here. This is September. I would bet anything this is September. Well, one of these is September 18th. I don't know which one. Maybe not. But anyway, September, from here to here, you drop half a point. That is specifically the Fed warning the markets. Okay. So the Fed is in a tightening cycle. John Hilsenrath, who is a Wall Street Journal reporter who seems to be the Fed's go-to guy to get a policy out there, had an opinion piece yesterday, I think. I didn't read it, but I read about it, that it's their opinion, it's his opinion, that the Fed at the 28th and 29th FOMC this month, that the Fed will continue its reduction. Remember, this is the last meeting that Ben Bernanke is chairman. One of my arguments that I made back in September, and I was wrong about this along with everybody else, that they would reduce, was that Mr. Bernanke wants to get this reduction policy in place now while he's still chairman so that it'll be harder for any subsequent chairman. At that time, it was not known to be Janet Yellen. It was thought it might be Larry Summers, to reverse it. Because he'll have two meetings now. Remember, the FOMC vote operates by vote. There are 12 regional FOMC. One or two of them always vote, New York being one of them. But they vote. 9 of them vote. The policies are determined by vote. The chairman, it is arguments that win. I don't believe that the chairman has 3 votes. Everybody gets a vote. So the views of the chairman may carry extra weight, but it's the vote that determines. He has to convince his colleagues for the policy. By putting 2 reductions in place, it makes it that much harder, in my mind, for Janet Yellen, were she so disposed to, without any change in economic statistics or the economic complexion, without any change in that, it would make it that much harder for her to change policy, to convince her colleagues, because not only has assuming there's no change in the economy, but you now have the Fed with a policy in place. And all of the Fed governors, to be sure, are very reluctant to be flipping around like it's a pinball on policies. So the longer a policy stays in place, especially a change like this, the harder it is to change without substantive change in the underlying economy. Okay, so back to it. The Fed is on a tightening policy. That's the rate policy. Normally, that would send tightening policies, tightening rate cycles last 2 years, 3 years. Normally, that would send the dollar higher. Has not been the case. In addition, the ECB reduced rates, and now, remember, don't anyone forget that Mr. Draghi, Mario Draghi, he's playing in the World Cup. I think where are they holding the World Cup this summer? I know the World Cup is on this summer, but I don't remember where it's actually being held. They're looking for ways to provide liquidity to the European economies. Brazil, thank you. I have some interesting stories about Brazil, but now's not the venue for them. It would take up too much time anyway. The ECB has been reducing the official rates, the main finance rate. And what did Mr. Draghi say last month? They were considering. Yes, I know. They would never, but I'm going to get to this one because I know exactly what I want to go to, and we're in pretty good shape here. There are a couple of trial balloons from Mr. Draghi and one or two others about negative interest rates. So the ECB, because they cannot do the same quantitative easing policies that the Fed has done, they are forbidden by their charter to monetize the debt. The Fed, of course, would say we're not monetizing the debt, but that's not true. When you buy Treasuries and you send the money out into the market, you are monetizing the debt. You can say whatever you want, but that's what you're doing. The fact that it hasn't caused inflation doesn't change the fact of what you're doing. You are certainly keeping Treasury rates lower by propping up the Treasury market. And what does that do? Well, that permits the government to borrow at much lower rates than the market would actually lend to it in other circumstances. Another monetization of the debt. Not strictly, but permitting the government to have much more debt at a much lower rate. The ECB is strictly forbidden from doing that, and so strictly forbidden from it, and the Germans and the Bundesbank is very much against it, that they can't do it. So the ECB cannot go out and buy German debt to lower German rates, which would have an effect across the EU. And they can't go out and buy debt of all, I guess now 18 countries in the EMU to bring rates down. They can't do it. The Germans take a realistic and, in my mind, accurate view of buying treasuries, and that is monetization of the debt. You can make many other arguments, as have been made by the Fed in the U.S., if necessary, and all this other stuff. And things would have been much worse, the counterfactual argument that the Fed likes so much. But it is nevertheless monetization of the debt, and the ECB is forbidden from doing that. So the ECB is looking for other ways to introduce liquidity to lower rates. Negative interest rates were one of the things that they took. If the ECB had put in negative interest rates, then I believe the euro would be much lower. Now, that brings back to my original point. The markets are stuck where they are, even though the ground underneath them seems to have changed dramatically in the past few months as far as euro strength, but without a catalyst, without an action, without something in the markets to cause a change, it can go on for some time. Markets can stay irrational, though the original quote, the original cliche is, markets can stay irrational far longer than you can stay liquid, but markets can just simply say irrational without any following phrase. You can just leave it there. So we have something on that. So we have U.S. economic growth far stronger. We have the ECB on a rate reduction cycle, or at least looking for it, and the Fed on a rate tightening cycle. And we have widening spreads between the 10-year here, although that's not the dramatic one, here. Between the Bunds, which I'm taking as a proxy for the euro, or the European bonds, and the dollar, and the Fed treasuries. Okay, so we have all the logic in place. Let me just show you another chart here. This one is more, let's see if I have this one here. Do I have the projection? Yeah. I didn't do the 2-year projection, but I did do the 10-year projection. Okay, this is a projection of the U.S. 10-year rate. Now, these are not accurate projections, of course, but I just want to give you a sense of where we're going with this. This is the steeper rise in the 10-year, and this is the one going back to. You can see now, where does this get us? These are the historical rates going back. Let's see if I have a longer rate chart here. Let's take a look at the 10-year. All right, here we go, 10-year historical. Okay. This is where we are in the U.S. 10-year. And these are the projections from the old chart, if you take this one or this line up here or this line here. So these are historical rates, not going back to like the 1980s when, someone said sound up there. Can everyone hear me? I just want to make sure. Let me put it in. Okay, no problem. So this is a projection on the historical rates going back 10 years. 10 years? Yes, 10 years. The projections, even from the extreme projection here, which is the steeper line from here, out to June 30th, 6 months from now, we only get the 10-year at 4.27 or 4.3%. That is not historically remarkable by any factor. It's in the middle of the range before 2008. Here's the range from 2004 to 2008. Even that extreme projection, which is right here, Q2, June 30th, right out to here. That's where we get it from, 4.227, which now, it's my opinion that the Fed would never permit this. So you're not going to get that. Even the more gentle projection gets us where? Historically, gets us right here. So if the Fed keeps reducing quantitative easing, and I think it's going to, unless something happens, it's going to be very difficult for Janet Yellen to get in there with her, even with her avowed and public interest and comments and concern for inflation, for unemployment. And she's in fact correct. U.S. unemployment rate is not 6.7%. The U.S. unemployment rate, if you take the participation rate, the labor force participation rate, back to where it was before the recession, then the U.S. unemployment rate is about 11.2%, I believe. If you take it back to, and progressively like that, so if you take it back to where it was even a year ago, it's still about 7.5% or 8%. So the U.S. unemployment rate is not 6.7%. That is nonsense. That rate is almost entirely moved down from where it was because people drop out of the labor market. They stop looking for work. Now, some portion of that, hard to tell, are aging baby boomers. Nevertheless, the U.S. unemployment rate is not 6.7, and the underemployment rate, which is probably more accurate, is over 13%. So her concern for unemployment is real, because unemployment, especially long-term unemployment, is incredibly damaging to the economy and also to the workers. The longer you're out of the economy, the harder it is to get back in. Skills atrophy, markets move. I think about my wife. She was an investment banker for a number of banks here in the city. And when we had our children, she did not return to work, and she's been taking care of the kids for 5 years, and it's great. We love it. We're glad we're able to do it. But if she wanted to go back now, the world has entirely changed. It's much, much harder. So the economic damage, it also reduces the productivity of the economy tremendously, because productivity is a function mainly of the labor force and the productivity of the amount, the size of the labor force, and the productivity of each individual worker, the economy in general. So you can reduce productivity, meaning each worker can produce more or less, and you can take workers out of the economy. And that's what's happening. Workers have left the economy. But as far as the projections that we're looking at here on the rates, it will be very difficult for Janet Yellen, even with her avowed and correct, I think, interest in unemployment, to move the Fed without, as I said earlier, without a notable deterioration in the U.S. economic position, to move the Fed either to stop or to even reverse its tapering of QE. And the primary reason, I think, is because the FOMC in general is now convinced that the policy has run its course, meaning it's no longer effective. Even though it's always been questioned about how particularly effective it was, the Fed argument for quantitative easing is nebulous. It's primarily a counterfactual argument. Well, this would have been much worse. There's almost zero proof of that. Any proof of that can only come from. So anyway, the policy has not been very. The primary substantive argument for quantitative easing is basically a counterfactual argument, which is based on. Okay, understood. Which is based on models. Okay, so we have 45 minutes today, so we will. Let me just wrap this up. I have covered all the points that I wanted to. I was going to go a little further afield with this, but this is my logic and my rationale for what is happening with the euro. So all of the traditional forms of analysis that we use to compare currencies, central bank rate policy, spreads on their securities, and economic growth in the two countries are pointing towards a stronger dollar. So what is inhibiting the euro? I think primarily it's two things. Yes, I will tell you what I think the reason is. The primary reason the euro has stayed high is because we are still trading as on the reactions of the world financial crisis. and quantitative easing. That's still in the forefront of the mind of traders, and also the notice from last summer and in September that the Fed is watching this. And just as credit market traders were wrong-footed by the Fed in September, so were currency traders. And so they're very wary of taking a substantive position in the markets and risking their capital and their profits until they have reason to believe that the Fed is not going to do that again. Because the Fed could easily do that again. If, say, rates started to move higher and the dollar started to move higher, and then Janet Yellen came out without anything, after she assumes the chairmanship at the end of this month, sometime in February, well before the next FOMC meeting in March, she comes out and gives a speech about the economic dangers and the costs of unemployment. That would have exactly the same effect on the markets as when the FOMC decided not to begin tapering in September. So these things, the markets are very wary of the rhetoric coming out of the Fed because it's been very effective in cutting the legs out from under positions.